Echo 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Tavi Costa again. He's the portfolio manager at Crescat Capital. Tavi, welcome to the channel again.
Thanks for having me again and looking forward to this conversation.
Yeah, me too. It has been about maybe 9 months since we last spoke. And what I wanted to start with is your assessment of the move from paper assets to hard assets that we've been covering these last few years. Where you think we are in terms of, let's say, what inning are we in this move? And maybe give us like a summary of what happened last year and the year before and what you see going forward maybe in the next 12 to 18 months.
We've seen a few waves of this whole move. I think the initial part was gold had the first move. Precious metals were the first ones to really move prior to the pandemic and then into the pandemic. And then after that, when we had elections and then Democrats took power in the U.S., this was when other commodities began to have a run, specifically the cyclical commodities, the coppers and lumber and nickel and so forth. All of those had a big move in 2021. We went to a consolidation for most of those years for gold and silver. Finally, we're seeing the appreciation of those metals relative to other commodities, and I think this is really interesting from a standpoint of what's happening in credit markets. I mean, we've seen now the yield curve invert for over, or the yield curve in the U.S. in terms of all possible spreads in the Treasury curve invert as much as 91%. In prior decades, every time we go above the 70% threshold, this was a time for you to buy stocks or buy gold and sell stocks, meaning buy the gold to S&P 500 ratio. So I expect that precious metals will probably going to be leading the way to the upside again, even relative to other commodities. But I've never seen a time in my career that all the entire thesis that we have here at Crescat really rests on oil. It is sort of weird to say this, but oil is at a critical point right now. It's very close to a breakout. If oil breaks out and we have another run up in commodities, which is already happening in most of the cyclical names. If you look at copper, it's already up double digits, silver up double digits, gold up double digits, nickel up double digits, zinc. And this is all the way back from, I believe, October for my calculation. And if you look at those, the one that we're missing, it really is energy commodities. And why is this so important? Because if we do have that, chart of oil breaking out, which I think it will happen, and we're certainly long energy stocks as part of that exposure, I think it will surprise a lot of people. We came into 2023 with this whole idea that a recession is gonna happen. And while I'm in the camp that we're gonna see an economic downturn and probably already started, and you can see some of that in the macro data already, it is a crowded idea. And a lot of people are thinking the Fed is going to be pivoting already by the middle part of the year and so forth. And you can see that on the euro-dollar curve. To me, if oil prices go higher, if commodity prices have another run up, which I think is very possible, it will change entirely what is the positioning in terms of expectation for rates. And I don't think the Fed will be able to pivot as soon as the market is thinking. So this, again, will favor tangible assets and will give another leg up on that, but also will be important to see what's next for financial assets, which had a recent rally here in the middle of a bear market, in my opinion. And if you're a fund that is systematically trying to increase your short exposure as you see the markets rally, I think this is a great time to be adding to your short exposure. So this is how I'm sort of thinking about this whole thing. I mean, long precious metals, long other commodities, but I do think the oil is going to be critical for the next 6 months, because if we do see a breakout and oil prices go up again, it's going to be a reemergence of the inflation story in a big, big way. And I think a lot of people are wrong-footed when it comes to that, especially the markets, and the rate market is also very wrong if my thesis is correct.
It's interesting because I was going to ask you about oil, and but you covered it. And but I wanted to know as well what that would do to the U.S. economy if oil goes back above 100, for example.
Well, there is a sort of a framework that we've used since '08 and other times when we had an economic downturn, where oil tends to collapse when the economy is, or the markets are in turmoil. But that's not necessarily true throughout the entire history of financial markets. In the '70s, in fact, we did see oil go significantly higher while the market was dropping, even at the beginning of the global financial crisis as well. And this is really on the back of geopolitical issues. I think there are so many potential triggers which give an interesting asymmetry to the trade of oil. But also, to me, there's just an implicit put option on buying oil today, just because I just find it hard to believe the oil can really drop much lower than the current levels. I mean, I put a cartoon one time where it shows a bunch of people lining up, to buy something, and it said, this little sign on top of it saying oil prices at $120, and then another place where there's no one in the line with oil prices at whatever $80, $90 a barrel. And it's very true. I mean, everyone was bullish, just a couple months ago when oil was trading at 120. Now everyone turned bearish because of this recession narrative. And I think that's extremely priced in already in oil prices. And I believe that if you have a reacceleration of the inflation problem, which I think this is completely mispriced right now, is it could change the entire environment. It could change, a lot of, especially in equity markets, overall equity markets, including the S&P 500. I think that would be quite negative for that. So, coming into the markets in 2023, it's just hard to not be long oil, along with the gold trade. And so I think this is going to be, and if you look at the number of rigs, for instance, right now operating in the energy space here in the US, in looking at the overall industry and how many active rigs are currently working, you can see that the number is rolling over. That's one important aspect. The second aspect is that if you look at the SPRs, the Strategic Petroleum Reserves right now, which were completely collapsing, as everybody know, the U.S. government was selling their strategic reserves, which is probably one of the most erratic policies we've seen in history. Well, now they're not doing that anymore. In fact, if you looked at on a month-over-month basis, that chart is actually decreased the least in over a year or two. And so it's it's been unchanged, the amount of strategic petroleum reserves, which it's kind of coinciding with this time when oil is not as much under pressure as it had been over the last months. So I just continue to believe that there is a good case to be made that if oil reaccelerates the upside, the Fed has to do more, not less, or at least stay higher than the market is expecting. What does that do to the overall equity market? And I don't think it's positive. I think it's negative. So those are the things, sort of positioning that it's really in my mind at this point.
Yeah, and I think in terms of the strategic oil reserves, they try to put some bids in the market, I think a few weeks ago, the U.S. government, but it was too high, and they said they're going to wait, and I think they're going to be caught short. And also, as you see here, the Republican House, they want to put new rules so that the government can't really sell the reserves as easily, even though Biden says he's going to veto that. So do you see a chance then with the economy slowing down, not just in the US, but in Europe and the UK, that we could see stagflation this year. And I guess that is a really bad environment for stocks.
That's right. I mean, I think stagflation is cheap right now as far as betting that stagflation could happen in an even bigger way in the next 6 to 9 months. And the reason for that has to do with the fears of recession, where everyone's shifted their positioning and their concerns from inflation to recession. And what caused with that is that now it's easy to find people out there claiming, okay, if we do see a recession, first, second quarter, big downturn, big change in interest rates, and then Fed has to actually pivot. That should be positive for risky assets. And I've never seen it's a crowded recession trade coupled with a crowded long equity market trade. It's very strange, and I don't think this is all positive. In fact, if you look at the repricing of equity markets so far in the last 1 to 2 years, has been completely through duration risk. I mean, we haven't seen really cash flows, the decline of cash flows or potential decline of cash flows from here, be really reflected in equity prices just yet. So I don't know. I think there's a lot more unfolding. I mean, bear markets are like this; they get confusing in the middle. I've a lot of people change their positioning and tend to confuse early bottoms or seeing bear market rallies as potential times to be reallocating capital in this part of the market. It's not my view. I don't think we are there. I don't think we're there at all, actually. And when you look at the interest rates environment that we're in relative to valuations, I think things are still very severe in terms of the multiples that you find in equity markets is still are multiples that you find during periods of disinflation, not like you just said, a stagflation potential. And if that's the case, I mean, most of the equity markets during stagflationary environments tend to trade at very, very low double-digit numbers. And right now, we're not there at all. In terms of CAPE ratio, we continue to be at very, very high valuations. In terms of even market cap to GDP, that on itself, it's a metric that continues to be just as high as it was during the tech bubble or peak of the tech bubble. We're just retesting those levels. You look at the technology space relative to the overall market, it started to roll over. There's more to go, in my opinion. I think our biggest position on the short side is Apple right now. We do believe that Apple has a lot more downside to go, and so for many reasons, and even from a fundamental perspective as well. So that's really where we're coming from. I don't want to claim like I know all the answers at all. I mean, I'm just using the lenses of a person who is watching closely what is very supposedly very crowded positions. To me, reading newspapers and reading what's out there just seems to me that a lot of concerns on the economic downturn, very, very little people or amount of people considering this reemergence of inflation being possible in the next, call it 3 to 9 months or so. And I think it's a lot more possible than people believe. And if that's the case, it will be a big change in the dynamics of markets, not positive for equity markets. And again, remember the roadmap of equity markets. Majority of the darlings, look at Amazon, look at Facebook, Netflix, all of those are already retesting the March 2020 lows, right at the lows of the pandemics. Most of those companies already, went there. If the S&P is yet to retest those lows, my goodness, I mean, there is a severe downturn ahead of us still. So I am concerned about it, and I think people should be as well.
So I wanted to switch over now to some more geopolitical topics. First of all, I wanted to share this screen here about something I just saw. Someone sent it to me earlier today about how gold has been flowing a lot from the west to east. Switzerland sent 524 tons of gold to China last year, the most since 2018. And of course, you're aware, of course, of the BRICS countries and the global south trying to create their own system, maybe global currency or something to challenge the dollar. And with that in mind, I wanted to ask you what you think of the news about Brazil and Argentina saying that they want to create a single currency and eventually, let's say, invite a lot of the other countries in Latin America to join. It seems like, to me, a little bit like Brazil trying to and Argentina trying to create a currency. It doesn't seem very optimistic, but one of the reasons they give is that they want to lessen their dependency on the dollar, and that seems to kind of make sense, seeing that the BRICS are trying to do that.
I think there's definitely some of those countries are seeking forms of reducing their reliability on the U.S. dollar system. However, the consequences of doing so could be drastic, especially for the Brazilian economy. I wouldn't put this on top of my agenda as things that I should be worrying when it comes to those monetary shifts. I think, sure, I mean, there is a push outside of the U.S. to not have the U.S. dollar as a reserve currency. I think that's seems to be somewhat of an obvious concern. Now, relative to Brazil itself, I think there are other things that are masking the real opportunity. The elections of Lula are not positive, are net negative for Brazil overall. However, the thing that is interesting about this is the value proposition of buying U.S. or Brazilian equities relative to other places is becoming more and more attractive. It is such a contrarian opinion because a lot of people are seeing this as a very negative development overall. And I understand the risk and or at least I can see the risk of this shift in leadership and those pushes towards creating a currency system with Argentina and perhaps other partners. However, at the end of the day, the Brazilian economy really follows a commodity market. And if you follow what's happening in terms of institutional capital chasing the Brazilian equity market, it actually looks pretty clear to me. I mean, 2022 is an example. Emerging markets were down over 20%, which is not as much as you would think in a day or in a year that developed economies are down as much as they were, especially the U.S. economy or U.S. equities. But the point here is the fact that Brazil actually was up during the year in dollar terms and also in Brazilian real terms. And it continues to show that strength. And it's nothing to do with the political environment. It has everything to do with, again, institutional capital looking for ways to spread the risk towards a commodities trade. The commodities trade has a lot of ways that you can express that view. You can buy Canadian companies, U.S. companies. You can buy commodities themselves. You can start private businesses and sort of do a VC approach towards natural resources. I mean, there's so many things you can do, but it's a small market actually relative to what those large allocators have of capital to deploy. And so they are looking for many different ways. And the BRICS is an interesting idea. And I think, to me, what we're going to learn in the following years is how the BRICS economies are just so different. I mean, I can't put Brazil in the same block as China, in the same block as Russia. I mean, China is a major net importer of commodities. they're one of the few economies that should actually, have a negative impact on a potential run-up of tangible assets in a very big way, and therefore why they're rushing to buy things like gold and other tangible assets, as they view as one way to hedge against that risk. And Russia is another part of the BRICS bloc, but while it is a commodity exporter like Brazil, it is a total geopolitical mess in the terms of, it's initiated a war, and also has geopolitical issues all over the world. Brazil is the only economy that I know of that is part of the BRICS, which remains a commodity exporter that is exposed to not only energy, but agricultural commodities and mining in a very big way, with a lot of prospective ground to be explored and developed. It still is sort of the Switzerland of South America when it comes to having relationships with other countries. It's a completely neutral, geopolitically speaking, economy. We'll do deals with Russia and also with the US. We'll sell things to and buy things from China too. And I think in the world we're entering, where the scarcity of natural resources are going to become more and more pronounced, it's just hard to believe the Brazilian economy is not going to gain some relevance despite the political environment in Brazil. And so if you are of that opinion and you look at the prices and multiples you pay for Brazilian assets today, that becomes attractive. And on top of it, you get dividends. Some of those companies are paying 20% dividends. How many places in the world you can find that? So I don't think you need to bet the farm. In other words, it's going to be volatile, ups and downs. You're going to have some crazy days that will prove to be extremely volatile in the Brazilian market. But I think it deserves a look, and it deserves an allocation. And so I find it quite attractive.
Yeah, and if you look at the currency here, at the end of 2021, the dollar was at 5.57, and despite everyone saying, "Oh, the world is going to end in Brazil because Lula is president," the currency is still 5.14. And I think with the Mexican peso, it was one of the best performing currencies last year. It even outperformed the dollar. And yeah, I forgot to say one thing about when we're talking about stagflation, just before we wrap up. Maybe you could give your opinion on how China is going to impact that as well, seeing that China is just given up on this zero COVID and their economy is supposed to open up again. I guess that could put pressure on not just on oil, but all other commodities, right?
Well, to me, the zero COVID policy, I think, had a lot more to do with the pressure from inflation than anything else. Had a lot more to do with almost like a monetary tool than anything else. And now that we're at the reopening of this, it will add to the thesis of the reemergence of inflation, no doubt. I do think there are more systematic issues in China, demographically speaking, and also just the way the economy is run through the net of imports of commodities, on top of how leveraged they are in terms of their housing market. And I understand some other parts of the global economy also have similar levels of leverage. It is not a place we are looking to deploy capital. Now, I can see that equity markets in China have fallen significantly over the last years, and therefore any small change of rebalancing in terms of allocation of assets could cause a big rip higher in Chinese equities. I think China will be forced to improve relations with the US over time, which is something sort of unimaginable right now. And I also think that this move from G7 economies to have to reindustrialize over time what we call manufacturing revitalization, it is hard to believe that that's not going to be a major driver for commodities, even more than the supply constraints that we have seen over the last years. And the reason for that is because if you go back to the early 2000s when China entered the WTO and they became the manufacturing plant of the global economy, that caused a major driver for commodity prices. We've seen commodities really had a major run up during that time. Brazilian economy did very well. Emerging markets in general did quite well during that period. Equity markets in China didn't do so well, which was interesting. And so imagine if instead of one economy, now you're going to have all G7 economies, the major economies in the world, having to reindustrialize, rebuild, and reshape the infrastructure they currently have in their own countries. And what would that do to commodities? On top of you have the Green Revolution. And I mean, I can go on and on and on of what those kind of demand pull aspects of the inflationary problem can become very secular over time. The wages and salaries growth now on top of that. So it is very easy to see how net importers of commodities are probably going to face some issues, and I think China might be one of those. And we know the leverage issue and how much debt they have, and so in my opinion, it's not a place to be deploying capital over the long term. But a lot of people have a different opinion on this. I actually have a very strong view on the Chinese economy, where I avoid it at all costs. And I do think there's a case to be made where the Chinese currency could devalue drastically given those changes over time as well. And so those are things for investors to consider when it comes to risk for global markets.
Great. Tavi, before we wrap up, do you want to tell the viewers where they can find your work and where they can follow you on social media?
Sure. Well, thanks for having me again. And you can just find me on Twitter at Tavi Costa, and also in our website, Crescat.net, where we put out letters and in-depth research regarding our views. And that's where you can find us there. Thanks again for having me.
I wish you a happy new year and a prosperous new year as well.
To you as well.
Thank you.